First off, I'm pleased to introduce our final presenter for the day, Dan Neville, Chief Financial Officer at Ascend Wellness. Ascend shares are traded on under the ticker symbol AAHW on both the Canadian Securities Exchange as well as the OTC Exchange in the US. Ascend Wellness Holdings is a vertically integrated operator with assets and partners in Illinois, Michigan, Ohio, Massachusetts, and New Jersey. Ascend owns and operates state-of-the-art cultivation facilities, growing award-winning strains, and producing a curated selection of products. We have been impressed by the remarkable productivity of the company's retail store locations, which produce some of the highest sales per store metrics of any US cannabis operator. Ascend is also one of the most recent companies to list on the public markets, offering a fresh opportunity for US cannabis investors. With that, I would like to turn the call over to Dan to walk us through Ascend Wellness and its story. Dan, over to you.
Hey all, I can't hear audio, I don't believe. Andrew, can you hear me?
We can, yep, we can hear you.
Okay. I am just gonna go then, and then we'll figure out Q&A as we go, I guess. Great. Rebecca, could you just move on to the overview slide, please? Okay. So my name is Dan Neville. I'm the CFO of Ascend Wellness. I've been with the company for 2.5 years. I joined in May of 2019. Prior to Ascend, I come from a traditional finance background. So I worked in investment banking, worked at a New York-based hedge fund for about 10 years before joining up with Ascend, originally as VP of Finance and then moving into the CFO role last August as we look to move towards our IPO. This slide provides you with a brief overview of our company overall before I dive into the investment thesis and update everyone on the progress that we've made to date. So Ascend Wellness is a vertically integrated operator with assets in Illinois, Mass, Michigan, Ohio, and New Jersey, and most recently New York. We've got an enterprise value of approximately $2 billion based on 2022 analyst estimates of $630 million and 2022 adjusted EBITDA estimates of $220 million. We're trading at about 7 times 2022 EBITDA. That 2022 EBITDA would represent approximately a 35% margin. Today, we're sitting at about a mid-20s margin, so we have a significant amount of margin expansion opportunity ahead of us, given that we haven't turned on our entire portfolio of assets. We have a strong balance sheet. We ended the quarter with $104 million of cash, and subsequent to the quarter end, we entered into a $210 million term loan with a 4-year maturity and a 9.5% interest rate. This term loan also has an expansion feature, which will enable us to pursue additional M&A going forward. A portion of this financing was used to repay our existing debt and refinance at a significantly lower interest rate. Prior to this financing, we had a weighted average interest rate of around 15%. We brought that cost of capital down to 9.5% through this financing. The proceeds, as I mentioned, will be used to repay our existing debt, as well as acquire MedMen New York and pursue additional acquisition and growth opportunities for the company. We're very excited about this financing as it brought down our cost of capital and represents a very good outcome that we were able to achieve as a newly public company. So this slide provides you an overview of the Ascend Wellness investment thesis. We call ourselves MSO 2.0 because we're a company that didn't pursue a strategy of state applications, but rather we went out and actively bought a portfolio of what we believe to be the best assets in the industry. We're now focused on building and scaling out these attractive assets with the intent to achieve scale in each of our markets before expanding and looking at new opportunities. Within these markets, we're focused on flagship locations. As competition enters the business, we believe in the value of superior retail locations. Like any other retail industry, will create long-term barriers to entry and will create value over time. We also have a very disciplined capital allocation program. Both Abner and myself were in your shoes. We were in the buy side, so we know the value of actively allocating our capital to the best return on capital opportunities that we see out there. The bulk of our expansion has been fully funded through sale leasebacks as well as debt and equity capital raised, and we're not biting off more than we can chew and are very diligent about where we spend our money. We've successfully grown our portfolio through M&A, and we see this as the fastest path to growth given the barriers to entry and the regulatory environment that's inherent in this industry. The company, as I mentioned, has room for further margin expansion over time, as only approximately 30% of our cultivation assets are generating revenue today. These are just a handful of reasons why we're confident that Ascend is positioned to succeed. The next slide provides an overview of our state footprint. We're primarily focused on flagship assets in limited license states east of the Rockies. We aim to have the best retail locations and have carefully curated our selection of assets. We've continued our strong growth and currently have 18 dispensaries open and 90,000 square feet of canopy operational today, with a robust pipeline coming on over the course of this year and into next year. Including the dispensaries that are set to open and our cultivation expansions planned, we expect to have 26 dispensaries and 285,000 square feet of canopy online by the end of next year. This represents our fully licensed, fully financed, and in development pipeline, and doesn't include any additional assets that we would acquire or future cultivation expansions beyond the phases that we have planned and financed today. We're pleased to develop such a robust pipeline in just 3 short years, with the company being founded in May of 2018. Next slide. Including New York, we're in 5 of the top 9 recreational markets and 1 of the top 3 medical use markets. We've ranked these assets in these states based on 2020 market size for both the legal and illicit use market, assuming that over time, the majority of illicit use will transition to legal. What's even more important than population and market size is the population per number of dispensaries. Based on the current footprint, our current footprint in this chart, it shows you why we're so excited about our opportunities in New Jersey and New York, as well as Massachusetts, combined with our continued success in Illinois. This slide also shows why Michigan is such a challenging market, given a very robust number of dispensaries within the state, with only 22,000 people per dispensary. We believe that by grading by population per dispensary, we can drive long-term value instead of focusing on short-term accretion within markets that may decline over time, which we do not believe is necessarily correlated to long-term value creation. Next slide. This slide provides an overview of our flagship locations throughout our footprint. We believe that we have the top locations in each state, and that these top locations in each state will have significantly higher revenue than other B or B- locations, just like any other industry. While Ascend is under 3 years old, we believe we've acquired some of the best licenses and the best local real estate in each of our markets. The top 20% of locations in the industry will generate 3 times the volume of just your average location. And we're seeing this today in Illinois. In the top left corner of the slide, you'll see our Collinsville store in the St. Louis area. This store does $50 million in revenue which is multiples of the average dispensary in the state of Illinois. We also recently opened the first recreational location in a downtown city in the East Coast with our flagship in downtown Boston. That's the third picture to the right. This has been 2 years in the making, and we went the hard route going after a marquee location that's right next to TD Garden and right down the street from Faneuil Hall. But we believe, again, that assets like this are unique and will protect long-term value creation over time. On the right-hand side of the slide, you'll see 2 of our locations in New Jersey. The first is our Paramus area location in Rochelle Park, which is a half mile from the Garden State Plaza on New Jersey 17 with 100,000 cars going by a day. And the second location is a location in Fort Lee, New Jersey, that's right across the GW Bridge. This location is being built out today in advance of the start of recreational sales in 2022. We believe that these locations will do significant numbers in the 2022 timeframe when New Jersey transitions over to rec. And we believe these are 2 of the highest trafficked, highest density locations in all of the state. Next slide. This provides an overview of our pipeline of assets. So far this year, we bought on 5 dispensaries, and we plan to open 4 more by the end of the year. We anticipate closing the MedMen New York transaction by year end, which will provide us entry into the New York market. MedMen has 4 operating retail locations across the state, which are currently in New York's medical program, including the flagship location located on 5th Avenue, just steps from Bryant Park. I will also note that our canopy expansions that we're anticipating, and we'll go over in the next slide, are expansions of existing cultivation sites. We believe that canopy expansions at existing sites are significantly less risky and have less execution and timing risk than greenfield projects from scratch. This should give you confidence in our pipeline and the timing of our assets being brought online, as cultivation expansions are the hardest asset to bring online relative to retail and have the most variability and risk relative to time. So this slide provides an overview of our construction progress at our grow facilities. We currently have canopy expansions underway in Illinois, Mass, New Jersey, and Michigan, and expect to have 235,000 square feet of canopy online by the end of 2021. The first picture in the top left is a drone image of our marquee Illinois cultivation facility, which provides us with significant scale to our vertical operation in the state of Illinois. And we are one of the top wholesalers in the state. We currently have 55,000 square feet of canopy in Illinois today in the indoor facility to the left. And as you'll see on the right, we're adding 58,000 square feet of greenhouse capacity that'll come online by the end of the year in our fully sealed greenhouse. I like this picture because it illustrates the scale of our cultivation operations, as well as the speed at which we move to market. When we took over this asset in January of 2019, we had a shell that was somewhat warm with a de minimis amount of canopy. We aggressively expanded our canopy ahead of recreational sales to achieve scale into a recreational market and be able to supply our existing dispensary locations within the state when others were struggling with supply. Now we have a fully built out canopy manufacturing distribution center and another canopy expansion underway. Our Illinois facility is the blueprint for our cultivation expansions across the rest of our states. The next image on the top right is a picture of plants being planted in the first phase of our expansion in our New Jersey cultivation facility. Around year end, we expect to have a second phase of the New Jersey expansion complete with additional canopy and processing capabilities. The first phase of expansion pictured here was started in April of this year, and we already have plants within it. This shows our ability to move at lightning speed to take advantage of new adult use markets. And we'll use the same playbook that we used in Illinois, in New Jersey, and other near-term recreational states. The image on the bottom left is a new flower room we've recently added to our Massachusetts cultivation site. We'll be bringing on an additional 37,000 square feet of canopy by the end of the year, bringing our total canopy at this site to 54,000 square feet. This expansion is in the final stages of construction. Lights and tables are being added, and we expect it to be online by the end of the year. Next slide. We also continue to build out our portfolio of brands. We have 2 in-house Ozone brands. Our core Ozone brand competes in the quality for value segment, and our other higher end brand, Ozone Reserve, competes in the better category. We also look to partner with West Coast brands to increase our product offering in the best category. As you'll see in the chart on the right, our Ozone brand brought in the second highest sales of any brand in the state of Illinois, including other notable brands like Rhythm, Verano, and High Supply, among others. The brand is developing a strong reputation in the market, and we're also continuously working to diversify our Ozone offering to provide more form factors to our customers. It's in our strategy to deliver to every dispensary within the state of Illinois every week a full assortment of products, and we believe this distribution strategy is a key part of our success. A lot of people talk about brands and brand proposition, and that all will matter in time. But today it's really about getting a full assortment of products on customer shelves, delivering that consistently on a week in, week out basis to be able to present your value proposition to the customers consistently. Our brand partnerships provide Ascend with a unique opportunity to expand high-end product categories and provide each of our stores with a variety of different SKUs and form factors, as well as consistent access to differentiated product. Our differentiated brands combined with our consumer-focused retail experience is paying off. Our stores are some of the top stores in the state and are optimized to have fast throughput, multiple points of sale, and efficient layouts. We also have an exceptional digital experience, providing customers with access to express pickup, online ordering, and curbside options to consume. We want to meet our customers where they want to shop and deliver our proposition to them however and whenever they want to shop. Next slide. Both Abner and myself come from financial backgrounds. As I mentioned, we were once in your shoes, and therefore we're extremely judicious in how we allocate capital. We're acutely focused on return on invested capital and know that for every dollar we invest, we want to make sure it's worth diluting our ownership in our existing portfolio of superior assets. We have a disciplined 2-prong M&A strategy. The first, in keeping with our strategy of going deep, not wide, is to continue to expand and look to achieve greater scale and optimize our existing footprint. While we have reached the regulatory cap in most of our states, we still have room to expand in Illinois with 8 retail licenses today in a state with a 10 cap. We're also committed to being a leader in Ohio. We have two dispensaries under agreement today, and would look to expand in Ohio until we get to the 5 dispensary cap. In addition, we're committed to becoming a market leader in Massachusetts. And while we have a good start with the expansion of our cultivation facility, we'd be open to the possibility of expanding our cultivation, manufacturing, and distribution capabilities within the state. The second prong of our M&A strategy is to expand in other adult use or near-term adult use markets in states in the northeastern US. While we would focus on contiguous states east of the Rockies, we'd be open to opportunities in other limited license states. And one state that comes immediately to mind would be Arizona. At Ascend, we're opportunistic buyers, and if nothing meets our acquisition criteria, we're comfortable with our current portfolio. We're proud of our Q2 revenue quarter-on-quarter growth coming in above expectations, and as a result, we were able to increase our full year 2021 revenue guidance to a new range of $330 to $350 million of net revenue. This new range implies revenue growth of approximately 130 to 145% growth year on year. We have line of sight into this new range as all of the assets required to achieve this revenue are already turned on. While our revenue growth is impressive and our adjusted EBITDA dollar growth for the remainder of the year will follow, we don't expect to have significant, we expect to temper our quarter-on-quarter growth sequentially going forward, as we mentioned on the Q2 call. We grew at 26% quarter-on-quarter in Q2, and while we expect to maintain a robust clip of quarter-on-quarter growth, at a certain point, you're running into the law of at least larger numbers. We have canopy expansions underway in Illinois, Mass, New Jersey, and Michigan, and expect to have 235,000 square feet of canopy online by the end of 2021. These expansions will drive the next step function revenue increase, with them coming online at the end of the year, but not impacting results until early 2022 when harvests come down. With that, I'd just like to go over the final value proposition of Ascend and the overall investment thesis. As I mentioned previously, we call ourselves MSO 2.0 because we believe we are a company that didn't pursue a strategy of state applications, but rather went out and bought the best assets and took advantage of the best opportunities that the market afforded. And we're now focused on building out and scaling those assets. Within these assets, we're focused on premier assets in our flagship locations. And we have a very disciplined capital allocation program. I'd be remiss if I didn't mention the management team, which we've continued to build out, and we believe we have the team in place today to achieve this aggressive ramp. We have a variety of experience with folks from capital markets, real estate and permitting, licensing, traditional retail, as well as traditional CPG backgrounds within the company, layered on with robust experience operating in a cannabis market. The company has room for continued margin expansion and will continue to march toward our peer average, peer averages, which range from 35 to 45% as we turn on the remainder of our portfolio. These are just a handful of reasons why we're confident as Ascend is positioned to succeed. With that, I will try to open it up to questions. I can certainly answer questions over chat.
Great. So how this is going to work, I will pose questions to Dan over
let's
the
see.
Q&A feature.
So what are the key factors to providing a highly productive store network?
He's got it.
I'd say one of the things is just optimizing our stores for high throughput. When we started out recreational day one of sales in Collinsville, we had a line 6 hours long. And now that didn't obviously last forever. There was still significant lines early on in recreational sales as we looked to handle a just tidal wave of volume and demand from our customers. And so what did we do? We had 13 POSs operating then. We jammed another 5 POSs into our Collinsville location. We implemented an online and reserve ahead ordering program. And by April of 2020, which also coincidentally we had to adjust for COVID, we were down to wait times of 10 to 15 minutes. I can't tell you how great it is for customers to know that when they come to an Ascend location, we will have the product available that what they want. We have a quick, easy online ordering reserve ahead experience that functions well, and they can get in and get out in 10 minutes. So I think that's one part of the key value proposition. And I think it's worth mentioning that we have always built our stores and built this company with recreational sales in mind. So typically when we do a build out, we're looking to have 12 to 18 POSs in a store. Our Rochelle Park location, despite doing smaller volumes today as a medical store, has 18 POSs within the footprint, and we have the ability to add 5 more. So while the volume isn't there today, we are positioned to service what we expect to be robust volume as recreational sales come online. I think other operators within the market may be challenged on medical to adult use transitions. They're operating out of medical stores with maybe 2,000 square foot of space. They maybe only have 4 POSs today. Maybe they can add, an additional 4 POSs. And a medical experience is also a very high touch experience. And so we found even internally, if you have a GM that is used to running a medical store, it's a big step up and big transition to move to rec. We have built the company for rec, and I think that allows us to take advantage and provide a very good, quick, efficient, but also informative experience to our customers. Next question. How is Ascend prioritizing between the opportunity of existing markets compared to entering new states? This is a great question. It's something we think about a lot. We've got some great opportunities for new states. Every acquisition that we look at, we've got to compare putting $1 to work in that acquisition versus putting another $1 to work in the great markets that we have coming online that are near-term rec markets in New Jersey and New York. So we have looked to fund our expansions, our expansions in New Jersey and in the future in New York, our cultivation expansions through sale leasebacks. Cultivation expansions are incredibly capital intensive. It requires a lot of time, money, and effort to put on those cultivation expansions. And we view sale leasebacks as an efficient way to achieve scale in our canopy in those markets. That strategy has allowed us to free up additional capital for M&A to go after new states. So we're taking a balanced approach, and I think any of the opportunities that we look at on the acquisition front, one, have to be right down the middle of the fairway in terms of our investment strategy, near-term limited license states, in near-term recreational markets, where we think we can achieve high returns on invested capital and be a top 5 player in that state. If we can't do that, we'll probably look to invest that capital in opportunities in New York, New Jersey, or go deeper in some of our existing markets like Illinois and Ohio. Next question and final question. Ascend operates in supply-constrained markets. How do you allocate between your own stores and wholesale opportunities within the state? So we pursued a strategy. We don't believe in the company store model. There are other companies that only want to run their own product through their own stores. We don't ever want a customer to leave an Ascend store because there's a product that they want and we're not carrying it because it's our own product. With that said, today about 35% of our sales within our stores are our own product. We do not have, fulsome product and production capabilities in each of the markets that we operate in. And we'd like to move to a 50-50, internal Ascend product, 50% external product over time. So that is the goal near term, to move to that model. Today we're at 35, we're moving towards 50, but we'd like to be a robust player in the wholesale market. We feel that there is value to extending our brands to the rest of the state, building up distribution capabilities, especially as markets become more supply constrained or less supply constrained, and building up wholesale relationships. So I don't think you'll ever see us move to, the penetration of our own product that you see with some of our competitors at 65% plus. We think the company store model died with Sears and Kmart. Amazon and the internet brought consumers choice, and they're going to continue to want choice. And so we'll give them what they want.
Great. Thank you so much, Dan. We really appreciate your insights into Ascend today, and we thank you very much for joining us as well. So thank you, Dan, so much for being here.
Thank you.
Great. Well, this concludes our lineup of presenters today. We plan to post a video of each presentation on Echelon Wealth Partners YouTube channel over the coming days, so please keep an eye on our social media platforms. We would like to extend a thank you to all the presenters who took the time to share their insights on the exciting and fast-moving US cannabis industry. We can clearly see that the momentum is behind the operations and the financial performance of these companies. And the recent share price performance has offered investors with an incredible investment opportunity. We heard from 5 of America's leading cannabis businesses that there's a long runway for growth ahead, and we look forward to participating as that unfolds. We'd also like to thank our clients and our audience for joining us on Zoom and on the YouTube live stream today. We hope you enjoyed the presentations.